So if you're sitting on the sidelines waiting for a housing crash or mortgage rates to get down to 3%, well, this is an article for you. Real estate experts, mortgage rates won't go back to 3% in my lifetime. And I like about this point is here's why. Because so many times people come out there and say, well, the market's going to crash because 2008 crashed. Well, that's not enough content to say the whys. So in this area right here, let's really go down and see what happened, why this person doesn't think that we're going to see interest rates at 3% again. So let me get my head out of the way here in a second. But if you're a U.S. home buyer waiting for a return of super low mortgage rates, don't hold your breath, okay? The short-lived era of 3% interest rates for the 30-year fixed mortgage is over and unlikely to return anytime soon, perhaps for decades. What actually caused this? So one can truly never nearly predict the future, but I don't see mortgage rates returning back to 3% range in my lifetime, says this writer. So let's go down through, and I know you millennials out there, you're like, okay, guys, I'm sick and tired of hearing rates. Rates used to be back in the day, 7% or 8%. Well, here's where mortgage rates have been over basically my lifetime. I got in the business in the late 80s, right through here. So you can see where I'm saying, well, a rate at 7%, well, it's less than half of when I got in the business, but I get it. So here's where rates have been over basically the last 50 years. They were way up here at 18%. They came back through and they stabilized. You see through here, since then, they were pretty much on the decline ever since, all the way down to this area here. Okay, so then all of a sudden we saw this and mortgage rates spiked. So what's the cause of all of this? Okay, so let's go down here. Why we won't see super low interest rates anytime soon. Historically, low mortgage rates during the pandemic were an exceptional measure during exceptionally uncertain times. With the pandemic came uncertain economic events not seen since 2008. Fearing a prolonged recession, the Federal Reserve followed the same playbook it used in 2008, pumped money into the economy to stimulate the economy. Okay, so we have the Federal Reserve pumping money into the money supply. It also brought down interest rates to 0%. And then you see quantitative easing with the federal government, or the Fed did also, is they started buying up mortgage-backed securities to artificially drive down mortgage rates. And that's what caused mortgage rates in January of 2021 to hit 2.67%. And then on top of all this, Congress also passed trillions of dollars in COVID relief to stimulate the economy. So you have basically interest rates at zero. You have tons of money or money supply in the system. Well, here's my prediction back in 2020. I said, this is all fine and dandy. It's helping the economy right now. But what you're going to see, here was my prediction, you're going to see a V-shaped recovery, and you're going to see inflation kind of rearing its ugly head that we haven't seen since the 80s. So here's what we've seen since. And let me reference what a V-shaped recovery is. A V-shaped recovery is a quick, sharp improvement in the economy after a sharp decline. So what we saw during COVID was basically everything just came to a halt. GDP, spending, jobs, everything. So you had a huge drop in the economy. And then all of a sudden, people start getting their stimulus checks, interest rates went to zero, all this other stuff happened. Then the doors cracked open where people could get out, start working again, getting those paychecks, start spending. And all of a sudden, we just had that woof, the V-shaped recovery. It would have been worse. Well, it might have been a little bit better if we didn't have the supply chain issues. So that's it. Basically, this is what you're seeing right now. The effects of all that stuff that was pumped into the system is now rearing its ugly head in inflation. So that brings us to this week and the Fed. So what we're going to talk about right now is inflation. CPI is one of the measures that the federal government watches. So there's CPI, which is consumer inflation. Think of that as the C. And then there's PPI. Think of that as P for producer. You have the producer price index. So how much inflation you have at the producer side. So we go over to the consumer inflation, CPI, and that report is coming out this week, and I'm going to show you that economic calendar right here. Huge week. Wednesday, we have the CPI, and there's all kind of numbers here. You got CPI, core, MOM, CPI, month over month, CPI, Y over Y. What is this stuff? Well, core CPI basically strips out food and energy in this whole database set that we follow. And I'm going to show you what the CPI is here in a second. But they strip out food and energy. Why? Well, you ever go past the gas station on your way to work and it's $3, and then you're on your way home, it's $3.70? That's why they pull out those things that just go like this in value. Okay, so they pull that out and they call that the core CPI. It excludes that data. And then MON means month over month. So it's focusing on June, May of last month to June of this month. Then you have month over month here, CPI, just the CPI. And I'm going to go over that number here with you in a second. Then you have CPI YOY, that year over year. So it's June of last year to June of this year. What's it done? So let's look at what CPI is. So CPI is broken down into this, and I'll leave this caption down below in the description. This is the Consumer Price Index by the federal government. If you go through here and it breaks it down into 4 parts, it's pretty cool because you can go down through and you can figure out all these parts. You can say, okay, well, here's where the numbers went in. This is what equated out to the CPI numbers. So you have areas such as all items, they were up 4%. And then you go over to here on major categories, and then you have energy, and then you have all other items. So the cool thing here is you can actually click here. Let's see energy. Energy is plummeting down through. You can see energy is down 20% since the last reading. I called that, guys. I was trying to explain to you guys that lumber, shelter, all these numbers are dramatically coming down, and the federal government and the Fed isn't seeing these numbers because their data is lagged. Trust me on this one, folks. You got to go with this one. Food, let's look at food. You can click that and you can see food at home, food away. Food away is nuts. We went out to dinner Saturday night, me, my wife, and my daughter. Our bill was, we just had salads and a couple of drinks. I could have went to Morton's Steakhouse for the same price. Well, back in the day, I could have went to Morton's Steakhouse for what I paid for a salad and a couple of drinks. So that's that part of it. So what you're seeing right now here is the breakdown of the CPI. Now, I'm not going to get, this isn't an economics course. We don't have an hour to go over it. But all I want to explain to you is the CPI number is basically what the Federal Reserve monitors to see where inflation is going on the consumer level. Okay, they're still saying it's higher than expected. They're saying it's at 4% right now. I'm saying, and most of everybody else out there that follows this data diligently, we're about in the high 2s, low 3s. You're going to see that, I can almost guarantee you, probably within the next 60 days. And then when you start seeing that, the markets are going to completely change. Okay, so let's get over to the economic data that we have this week. And that again is the core, the CPI is through here. And then we have on Thursday, we have the PPI, which is the producer price index. So between tomorrow and Thursday, there's a ton of data coming in. Why do we concern ourselves with this? Well, because inflation's getting out of control, the Federal Reserve's doing what they need to do to curtail this. So we go to the CME's Fed Watch tool, and you have access to this, and the links down below as well. What this does is it gives us this information. What is the likelihood that the Federal Reserve will change the federal funds target rate at the next meeting? Well, you go down through here, and you're going to see, well, now let's go to this. You go over here, and you put in probabilities. You go over through here. Right now, the federal funds rate is 5 to 5.25. If I get my head out of the way, you're going to see that in this column right through here. Okay, the 5.525 right here. I don't know how to do that on here. I'll put an arrow up there. So you can see it. The next category up, 5.25 to 5.5, would be a 0.25% increase in rates. Well, there's a 92% probability the Federal Reserve is going to do that at the meeting that they're having on July 26th, which is coming not too far from now. So that's what the predictions are, that the Federal Reserve is going to increase interest rates. So what we take with all this data, there's really not any data out this today, as you can see right through here, other than short-term energy outlook. So based on the information that the markets do have right now, here's what's happening. So this is what I see on my screen on a daily basis. I watch the bond market. Why? Well, because I'm a mortgage advisor. My goal is to track mortgages, mortgage rates, mortgage programs, educate you guys on, how you can buy properties, how you can buy your own home, maybe investment properties. I'm going to give you my information at the end so you can reach out to us. But this is what's going on in the markets right now. So what you need to focus in on is basically what's in the center screen right here. And it says right up through here, MBS. What that is a mortgage-backed security. It's a bond that trades on Wall Street. We focus in on that because why? What's a mortgage bond security? It's the yield. The yield on this bond, this thing you're watching on here, is the biggest component of your mortgage rate. So we follow this meticulously. What you're seeing on the screen right now is the price at 96.98 and the adjustment that's taking effect right now. It's down 2 basis points. What does that mean? Well, all you need to know is if the price is down, there's an inverse relationship with the price and the yield. So if the price is down, that means rates are up. Prices are up, rates are down. Let me give you an analogy of this, and I'm not going to try to draw out this video any longer. Let me explain how this works. So let's look at it as a price of a bond going up. Okay, so let's say for today, I give you there's a bond, there's a coupon, there's an MBS bond that's in your hand or in my hand. I give you $50 today. Okay. And that bond, when it matures, I'm going to get $100 back. So I'm going to pay you $50 today for the bond. Next year, you're going to give me $100 back. Okay. So what was my yield in that equation? Well, I gave you $50. You gave me $100 back. I doubled my money, 100%. Okay. So now let's say I give you $100 for this $100 bond. So I messed it up a little bit at the beginning. You have the bond. So I give you my $100. You give me the bond. Okay. Then next year, when the bond matures, I'm going to give you the bond back, and you're going to give me my $100 back. Because remember, I paid you $100 for the maturity of a $100 bond. So I give you $100, you give me $100 back. What's my yield? 0. So can you see when I paid you 50, my yield was 100%. When I paid you 100, my yield was 0. So as the price goes up, the yield comes down. That's basically how it works. So here's where mortgage rates are today based on all this information. Now, these rates are published by Mortgage News Daily on a daily basis. These aren't my rates. These aren't any bank's rates. These are just kind of a tool to monitor. Basically, what this is an average rate for this kind of borrower. So Mortgage News Daily surveys lenders all over the country and says if you had a first-time home buyer buying a primary home that's a single-family home, not a duplex, not a condo, not a townhouse, it's a primary home. So you got those three. You have a 740 credit score, and you're putting down 20%. Well, that would most likely be right about where your rate is. Okay, so a lot of times people will say, well, Dan, I got a 30-year fixed rate, and I'm paying 5.99% rate. I'm like, guys, how? It's like me saying, gas down the street from my house is $1. When the national average is 3. How did you get $1 for gas? Well, you might have had to buy 4 pizzas, a case of beer, 3 cartons of cigarettes, and a car wash. Well, okay, then you can get that gas for that price. But, there's probably a catch. If your rate is much, much lower than that, there's probably something wrong. If it's much, much higher than that, probably something wrong as well. So what kind of rate would you qualify for? Well, let's get over to it and let me show you how you can find out. My name is Dan Frio. I'm a mortgage advisor. I can help people all throughout the country. I'm federally chartered, meaning I can help people in all 50 states as well as Puerto Rico. We're also one of the country's largest mortgage brokerages. Okay, what that means is I have my products plus about 70 other companies, mortgage lenders, banks, finance companies. I have their programs to offer you guys. I have their programs and their rates to offer you. So we're hoping to be your one-stop shop where we can shop your loan with over almost 80 different lenders with one credit pool and one application. So that's what we do for you. So if you're out there and you're saying, hey, I'd like to figure out if I can maybe buy my first house, maybe buy my first investment property, I'm drowning in debt, I'd love to pull some equity out of my house to pay off that debt, we'd love to help you. Best way to get us is give us a call, 844-775-5626, or just click the Apply Now button right over there and you're on your way. Thanks so much for watching, guys. God bless, and I hope you learned something today. See you next time. Bye-bye.